All right, ladies and gentlemen, like I always say, coming to you from our Joburg office. All right, whenever you're watching this, might be in the morning, might be in the evening,
Could
but
be.
we are premiering in the evening.
Yes.
So do I say good evening?
Brother, say good evening. Sambonani Ikaya. I think I got it right, no?
Yeah,
Sambonani Ikaya.
Yeah, Sunny Bonani. Yeah, wait. San Bonani.
Sanbonani
San Bonani Ekai.
Ikaya. Does it mean welcome to all the guys at home?
Yeah.
Okay, I got it right.
It's like it's a greeting, Sunny Bonani, San Bonani. Yo, sorry if I'm
guys.
butchering this, guys, right? But San Bonani Eka, yeah, like hello everyone at home.
Everyone at home,
Yeah.
man. Wherever that home is.
Wherever their home is.
Fantastic to be with you
Alright.
guys.
Yeah, we are back, guys. It's been a long time coming. We are back,
Yes,
my man. Like
yes.
just before we went on right now, we just said
Yeah.
how good it is to be back.
Yes.
You know?
And I mean, look, from a episode, we're in episode 15.
Yeah, episode 15.
Episode 15. We've been very busy. A lot of sessions with the clients, and it's been really crazy.
Yeah, it's been crazy.
But we are back for another episode,
We
guys.
are back for another episode, right? Just before we get onto it, make sure that you subscribe to our
Yes.
channel. We're currently sitting on 3,500 or 400 and something.
3,400 subscribers.
Yeah. Let's pump that up to 4,000, guys. Let's
Yeah.
push this to 4,000 subscribers.
Yeah.
Pump the like button, the notification bell.
Yes.
You know, and let's just engage, get in touch, you know?
Yeah.
Yeah,
All right.
definitely.
So, brother, what do we have on the menu today, man?
You know, look, the last time we did an episode, there's been a lot of things that happened, you know.
Yes.
And I think what's on focus right now is looking at the US economy.
The U.S. economy,
and
those
what is going on now.
Those are interest rates we've been
Those
chatting
interest
about.
rates.
Yes.
All right. So that's what we're going to talk about, a little bit about here in this session, you know, looking at where it's coming from, where it is right now.
Yes.
The inflation data, that yearly inflation, look at where it's coming from, where it is right now. It's just been too much, if I may say, right?
Yeah.
It's just been too, well, we know what they wanted, what they're trying to do, but the way it's been just unfolding, man, it's just been...
Man, it's like a casual kind of a thing.
Yeah?
But also not casual at the same, in the same time.
Yeah.
At the same, pace. It's as if we want to cut, we want to see the dollar do what it needs to do. But then again, it's like, okay, do we have to cut? Because they actually at that almost 2% mark.
Almost. That's the yearly inflation, almost 2%.
Almost 2%. Bro.
And you said something now, do they have to cut? There's pressure for them to cut.
There's pressure for them to cut, but just imagine. Remember, I think we had this chat. I'm just going to the calendar here.
Sure, yeah.
Just imagine they said, we are not cutting September. We're cutting October. That's going to be a crazy one in the market.
It's going to be a crazy one.
Because they had said there's a conservative cut of 0.25%, 25 basis points.
Yeah.
A 0.25%. Now imagine they say, because it's so conservative and we're so close to our target, we don't have to cut now. We can actually cut twice in October. Example. And then November, we go for the third one. So we have an aggressive one in October. Aggressive one.
Like 50.
50, 75.
Yo. Yeah, but
I'm being a bit crazy here, though.
Yeah, no, look, it's good to be crazy. But remember also, I'm going to raise the point of soft lending, you know. They want that soft lending.
Ooh, come on.
So now the point that you've raised, it's a very important one. We need to just, not debate, but just unpack it proper.
Yes. Yeah.
I think because of the pressure, I think they would want to cut right now. And then on our stream that we had a couple of weeks ago, you brought up a point where what if they cut now and then they don't cut on the following one,
And then they wait for next
and then
year.
they wait, or maybe they wait for November, because now it's September, they cut.
Yeah.
They don't cut November. I mean October.
And then they cut November.
They cut
again.
November.
Which means it will be an aggressive one.
Could be.
If they cut 25 basis points now in September, there's 75 left now.
The 75 left.
You see? So
Yeah.
if they're going to cut in November and they don't leave it for next year, for me, it's just from 9%, bro. That's my kind of thinking. From 9% to 2.9%.
That was 9.1%.
9.1 is now at 2.9, right?
Yeah, 2.9.
That is a major shift, bro.
It is.
That is major control over the economy.
It is.
And so I think in as much as they are pressurized to cut, they're in control of the economy. And that's the thing that I'm leaning towards. Because a conservative cut of 0.25%, it tells you that they're not really stressed. Even although they pressurized, it's built into the system to say they have to cut in September.
Mm-hmm.
But still from 9.1 to 2.9, that's major control, bro. They're doing a marvelous job.
Yeah, I was about to say that there is progress.
There's progress, yeah.
Because they've just been adamant on that 2% target. So now it's on 2.9%.
Yeah.
I think they need to cut, I think they need to cut because now, and the reason they might go with the conservative cut is that it's just, look, inflation is not on those targets as yet. It's not at 2%, but it's on 2.9%. So which means they haven't reached the target as yet.
Yes.
But now they wanna just cut with small just slowly get into it, but then monitoring the data, the CPI data.
Yeah.
Like cutting 25 basis point now.
Yes.
And then just monitor. Because we have the CPI before the interest rates actually.
Yes. But now, brother, this is my next question now. They want to reach the 2% target.
Yeah.
No problem. But I'm quickly trying to find here, by when do they want to reach the 2%? You see, because that's another question now.
So they haven't really, revealed that, them themselves, they don't know when they're expecting this cut.
Yeah. No, I mean like...
I mean, so not the cut, but the 2%.
Yes. By when do they want to reach? Is it 2024? Is it 2025? You see, because if they say it's 2025 that they want to reach the 2% inflation rate, then it means that we're not going to be as aggressive as what people think.
Yet, yeah.
You see what I'm saying, bro? That's my point. That's what I'm saying. What if they come, T-Man, and they say, all right, guys, we've evaluated. The labor market is doing phenomenal.
Yeah, sure.
Prices is really under control. Inflation is not going to push up. It's stable.
Stabilizing.
We don't need to cut. Let investors also eat a little bit. Let's keep those interest rates the same.
So how do you think the markets will react? Imagine they're not cutting because now investors are anticipating the cut. They are waiting now, right? And then they don't cut. How do you think the markets will react? Looking at the dollar has been taking a knock.
Yeah.
The DXY has just been falling. Euro USD has just been pushing to the upside, gold and so forth. Now, if they don't cut right now, it simply means that dollar weakness is going to continue.
It's going to continue.
Could continue.
Yes, exactly. If they don't cut, dollar weakness continues.
Yeah.
The DXY is at now 101 points. It's been coming down, like you said, steadily.
Yeah.
It's kind of retracing a little bit now after that dip there.
Yeah, sure.
So it's retracing. Now that high that gets created short term, it's going to be very interesting because even in our market review meeting, we had chatted about short term and medium term.
Yeah.
We do think medium term, we still have to come down there because there has to be cuts, right?
Yeah.
But at this point in time, there seems to be that short-term strength that's coming in now. Is it sustained? I don't know. Because if they flip it and they say, guys, we're keeping interest rates the same, we are not cutting right now, that changes the whole technical chart there now.
Change the whole outlook.
Because now we move from short-term strength to possible medium-term strength as well. That can make the dollar go up now in value. And then when they start cutting, we have a big cut that comes down. You see what I'm saying? It's just different scenarios. Different scenarios.
Because I'm also playing other scenarios in my head. And that's the beauty of looking at the markets and just reading these. Like when I look at the charts, I'm just thinking it's like I'm watching a movie somehow. Because as the market unfolds, it just gives you these turning points.
Exactly.
So now the scenario I'm playing right now in my head is, I'm thinking of that CPI the week before. Yeah. Right now, yearly inflation 2.9%.
2.9.
Right. What if it doesn't go down, it goes up to maybe north of 3%.
North of 3% again. Then we're going to have to raise those rates again.
Sitting on 5.5%.
5.5. So we're going to have to raise rates. We're going to have to raise the rates again. But then obviously, if that inflation number goes up and the percentage increases, it's in as much as it's not good for the investor, not for the investor, for the consumer, there's actually like a dual kind of advantage happening there.
Okay.
Because if the inflation, or at least the CPI goes up, it means there's spending that is happening in the US economy.
Yeah.
Which is on the day, the CPI, if it's higher percentage, it's good for the dollar. So on that specific day, it's good for the dollar. And we get a stronger move in strength in the dollar. But if it consecutively goes up, that's where inflation kicks in. If there's more than 3 or 4 consecutive raises in the CPI, That means that prices are obviously getting more. There's more spending, which means companies can ask for higher prices because the demand for the spending is there. That's how inflation, kicks in.
Yeah, but at the same time, on that point, sorry to cut you. So you said it simply indicates that the spending in the country, which is good,
Which is
for the
good.
country, right?
Yes.
But now they're still spending when prices are still high,
Yes.
right? Which means even though they're spending, they still want prices to go down, even though they're spending. But now,
Absolutely.
since it's below 2%, it's a little bit better now because they can spend more.
They can
now.
spend more.
Yeah.
So if it tops above the 2.9 and 2.9, let's say we go to 3%,
Yeah.
or 3.1%,
3.1%,
in
yeah.
as much as it's going to speak to the inflation here
Yeah.
and the interest rates that could be raised now because of that, we also need to say it's good for the GDP of the US that the spending is happening. Just because it's at 3% doesn't mean they're going to raise interest rates, because inflation from 9.1 to 2.9 to go back to 3.1, look at that jump from 2.9, 3.1, and then you look at the distance to the 9%.
Yeah.
There's a big gap there.
It's a big gap,
So
yeah.
it doesn't mean that they're going to raise the interest rates now because of that.
No, I don't think they're gonna raise this yet because
Won't raise.
they stopped raising when inflation was just approaching the 3%, I think.
Yes.
Right? That's when they stopped raising.
Yeah.
So it's just been the same for, I don't
Yeah.
know, like 10 months, 11
You
months.
you
a long
mentioned
time.
for a very long time. Even the cuts, I think you mentioned in the market review meeting as well. They've been looking to cut for a few years.
Yeah.
You know.
Look, they've been looking to cut. I mean, this cut will be the first time in 4 years
Yeah.
that they're gonna cut.
Yes, man.
Imagine 4 years. So, but that CPI print, yes, it's been going down. Much progress. I think they stopped raising the rates.
Yeah.
When it was approaching 3% or
Yes.
4% there.
Yes.
So now, if it happens that it goes back to 3.1%, I don't think they're gonna raise. They're still gonna keep it the same.
I think they're going to keep it, yes.
Because they
Yes.
still they are data dependent. So
They
they're
are
still
data dependent.
monitoring the data now.
And as it looks on this graph here, brother, I have a graph on the inflation rate, right?
Sure.
We're currently obviously at the 2.9%. We're currently at the support, all right,
Yeah.
of 2.7 actually.
Support of 2.7.
2.7%. So from 2.9, there's a very strong support at the 2.7%.
So which means a while back, inflation was on 2.7.
Yes.
Stayed there.
Stayed there, had a dip to 0.1, and then we pushed all the way up there to the 9 point. Yes. So that was a major jump.
Yeah.
So now we are actually retracing now from that 9.1, if you look at it from a technical angle.
Sure, yeah,
Right? And that retracement is going from the flat to the surface to the sharp to the deep. We are in deep retracement now,
Yeah.
which is powerful, right? And we're at a support level now going towards the 2.7, which we had in 2017.
Sure.
2018, which went up to 2.9. And then we have year 2020, we were at about 2.5%.
2020, 2.5%.
Yes. So we're fluctuating between 2017, 2020, all right, coming back into those levels now again with the inflation.
From 2020, that's when it jumped up.
From 2020, it dipped one more time,
Yeah.
all right, and then it pushed up completely to 9.1.
And that was when there was COVID.
Aha.
It was rife at the time.
2020, 2021, 2022, the peak, obviously, we saw June 2022
Yeah.
of 9.1%.
Those are COVID levels.
Those are COVID levels.
Yeah.
And because people weren't spending, remember, people
Yeah.
weren't spending because
Yeah,
there was no one was going to
there was
work.
lockdown and
There was
all of that.
lockdowns, right? So no one's spending, they're sitting with savings. People are saving money during inflation as well. And so with that inflation going up, now investors need a chance to make some money.
Sure.
Because economies need to balance it out, right? So if the consumers aren't spending, where's the government going to make money? They have to, because people are working. There's taxes on individuals and there's taxes on businesses as well.
Yeah.
But if businesses are not making money, then how does the government tax them, as an example? Even although they must pay, you still have to pay.
Still have to pay,
But there's going to be issues in that specific arena there. There'll be policies and things that have to happen, right? Arrangements that needs to be made and so forth.
Yeah.
So it slows down 100%. So now that the guys are retracing and we at 2.9 again, because we were there in 2020,
Yeah.
do we break below? We go to 2.7 now and even 2.5 that we find in 2017. So are we going back to 2017 levels, bro? And I can be more accurate here. 2017, we were at a peak of 2.7%. That's the accuracy now. The peak, February 2017, we had an inflation rate there of 2.7%.
So I'm thinking now, looking at we in September now, right? We're approaching the festive season, right? And now we're on 2.9%. The
Yeah.
question that you raised now, can we go to 2.5 at least? To break 2.7, go to 2.5. I'm looking at where we are now in the year, right? We're approaching the end of the year.
Spending a lot, no?
That's what I'm thinking right now. There's going to be too much spending now. There's going to be too much spending. Of course, the NFP figures might go slightly up because of the demand in jobs and the increase in the creation in jobs.
Yeah.
But can it go at the end of the year? Can it go to 2.5? That is, it is a possible, what I would say, a possible target.
Yeah.
But hey, man,
Bro, I think they're going to at least go to between 2.9 and 2.7.
so it's on 2.9. So you think it's going to jump to 2. Maybe
Between, maybe
Yeah.
2.8.
2.8.
2.8, 2.85, 2.82. You know what I'm saying? Like somewhere there. And if not 2.7, maybe 2.79 or something like that. In between those, we might just go to that specific area. Then it's really safe now, because then from a cutting perspective, from an inflation perspective, there's a lot of control.
A lot of control.
There's a lot of control. I mean, that push to the upside in 2020, to retrace back, bro, from that is insane.
And I remember also the NFP at the time, it pushed to like high figures.
High
man.
figures.
Like high figures.
Over 200, over 300,000.
Yeah, exactly.
Jobs.
Pushed to high figures.
Yes.
So inflation, rather, the jobs market is like you said, there's progress. There's been progress there.
Yes.
It's looking proper.
And they're trying to control the labor market.
Yeah, they're still trying to, yeah.
Exactly, because that's what's going to push the inflation up. Because if people get jobs, they get salaries, wages, they are going to spend more.
Yeah,
They'll
yeah.
buy more houses, there'll be more cars that will be sold, because there's salary, there's income coming in.
Yeah.
You see,
Yeah.
and so then that then pushes inflation up, because there's a demand. That's just how it is, right?
Yeah, and remember, the dual mandate for the Fed is that jobs market, right?
Yes.
They want to see an increase, obviously, in jobs and all
Yes.
of that, and then also price stability, right?
Yes.
That has been the mandate, I don't know for how many years
Yeah.
now. I've just been following that. So the labor market, we can agree that it's doing well,
Yeah.
but it can still improve.
It can still improve.
Right.
Absolutely.
It can still improve, definitely.
Absolutely. So just from a trade, just from a dollar index perspective,
Sure.
remember we said that we are at the 101, right? I just want to look at the chart real quickly here, bro. Maybe just for the guys also, maybe just to let them know, we are doing NFP, which is going to be interesting on Friday.
Oh, yes. Yeah. NFP this week. All right. While Ash is checking the
Yeah.
chart, don't forget to subscribe, like, and share, guys. Comment down below, let's get the engagement going. Please share it to everyone. You need to share it so it can reach more audience, right? So NFP this coming Friday on what's the date? The 6th.
It's the 6th.
The 6th this coming Friday, we've got NFP. Excited about that. You're gonna see how the labor market is doing. Next week, there's the CPI. My goodness, these first 3 weeks of September is gonna be very crucial and important for the dollar and the economy in the economy of the US. All right. So the DXY, you found it?
I found it, bro. It is looking insane. It has a high, and then it has a support that's actually moving here. If you can just check
Yeah,
it there on
sure.
that side there. You see that? So it's literally sitting at that support area there of that 100-point mark. Now, if the guys go and check this out, right? The 100-point mark on the index here suggests that when the points are above the 100, that the currency is actually appreciating in value. When it goes and dips below the 100, it's obviously the opposite. It's depreciating. So we are literally at that support level of the 101 and the 100.
That's a very support level.
That's a crazy support level. So if we do push below, we could see us going as low between 94 and 99. So between 99 and 94 for this dollar to possibly find some support. And that is probably what those cuts could do.
So if you draw the Fibonacci from that low here to there, let's see where the 61.8 is or the 50 there.
All right, let's see.
Right, so we can look at possible support
Areas there.
So it's on 50 right now.
It's on the 50 right now.
Yeah.
Wow.
On the 50, right? And that's a very important level.
Yeah.
That support on 100. Very important. I think historically it's just been important for the DXY.
Yes.
So that's 61.8. It's on check this.
That's about 99.
That's 99.
And the 78, 0.7 is 94.
That's
so
94.
So it's actually very accurate with that fib retracement.
And guys, look, I mean, we're going to show this chart,
Yes.
obviously on the screen, right?
Yeah.
We are looking at the weekly time frame right now.
The weekly time, monthly, sorry.
Or the monthly time frame right
just to try and engage, what is the medium to the long.
Sure.
Because the short term, it's obvious, we're not going to see this movement on the short term, right?
No.
So medium to long,
Yeah,
what do we
medium to
possibly foresee between 94 points and 99 points on the DXY, which means this has a significant movement opportunity for our major pairs, guys. For gold, it all filters in gold and pushes higher.
Gold is going to push.
It's going to push higher. And I don't know if I mentioned this last week or the week before. I did a bit of research there on what they expect 2024 still to hold for gold, to push up to $2,800 per ounce.
This year.
Yeah.
Just before the end of this year.
Yeah. So we are on 2,500. So that's 3,000 away. Which is extremely important. Sorry, 300 away.
300 away, yeah.
Which is very, very significant if we see this dollar come down here. That means that gold price, the correlation is going to be accurate.
So this is how, your more seasoned professional traders, they would take to look at the charts, not looking at one instrument, but looking for correlation.
Exactly.
So that's what you're doing right now.
Exactly.
Value for the guys watching.
Value, big value.
Big value for the
So
guys
that's
watching.
gold, that's silver. The guys can start looking at those two charts, right? Gold, silver, even Bitcoin itself, crypto.
Yeah.
There could be something there's running. I mean, you've been on crypto now for a couple of weeks, months, and you've been looking at that long-term move, medium to long-term move.
To the upside.
To the upside. And if this plays out the way we are chatting now, and it's as much as the Fed is saying it's 0.25% basis points, if that's the case, then we're seeing those significant movements coming, bro.
Hey, man, I remember during lockdown, that time was a good time to be a trader, that time, because of COVID-19, how the market reacted. So this time is also a good time to be a trader this time because of these news that is anticipated by investors.
Exactly.
I'm looking at the chart and I can see that highest high the market created there, right?
Yeah.
Where that Fibonacci ended there.
Yeah.
And then you got that higher high, that lower high there.
Yes.
Right? So so according to structure, if you're looking at the descending structure,
that's a lower high, right?
Yeah. So we're looking at the possible lower low to come in.
Yes.
We're looking at the 61.8 to be filled, or even the 78.6, but depending on obviously how the data is released.
But now check this, bro. Check this now. Okay, so I agree with you 100%. And if we're coming in that structure coming down, we looked at the monthly chart. Now I'm looking at the 6-month chart here. Because the 6-month chart is also giving us something. If we come down in this channel, as you were mentioning, because high, high, right? But that wick there is a problem, bro. Look at that wick.
No, that wick is a rejection, So you're anticipating that it can be filled.
Absolutely. But
look at
not now.
Yeah, okay.
Not now. This would be us moving down 100% like that.
Yeah, look at the potential to the downside.
To the downside.
As opposed to the upside.
To the upside, right? Now watch this. I'm switching now 12 months. A little bit longer now. Right? If I do that, and let's try and zoom out, and let's see. So 19, look at the year there. Let me not scare the guys with the year.
Sure. Were we born?
No, baby boomers there. We were not born.
We were not born.
So this now in itself, is that a support area? Long-term dollar. You see what I'm saying, bro? But we can see medium to long. That is the possibility of us coming down first. You see that, brother? So we know in this specific chart from a technical angle, the dollar is coming down here.
Sure.
At this point in time. But is this support for the long-term movement to the upside back to the 164-point zone? Obviously, that's much long-term as we know.
Yeah.
But right now, medium-term, that's...
at least.
At least.
The market breaking below that 100 mark.
Yes.
Maybe going down to that, the 78, which is on 94, I think.
There we go, 94.
Possibly maybe that low there. Right there. On
89.
89.
Exactly. So we're literally giving the guys a great summation here in terms of medium to long. We're not dealing with short term at this point because the cuts are obviously looking at things for long term. That's what the fundamentals is, right?
Yeah.
Fundamentals is the longer term movement of an asset, but it's broken up into your monthlies, your weeklies, your quarterlies, and your annuals, so the guys can track. At this point in time, guys, we are seeing that from a medium term technical chart, it seems like there is still some downside here with this dollar.
It's a good time to be a trader.
It's a good time to be a trader.
So if you
bro.
want to open an account with us,
Yeah.
the details are on the bio.
Yeah.
Right? Check the description. There's a link there. You can follow us on all social media platforms. you know.
Yep.
Yeah, no, look, this is an interesting outlook
Yeah.
of the DXY. Right? Like I said, take it price action by price action.
Yes.
You know, let it unfold.
Agree with you.
But yeah, no, look, it's the cuts. The cuts are gonna do something
Yeah.
in the markets, man.
Anticipation for NFP, do you think we're going to get a nice, robust move there? Good jobs coming out?
I think for this whole year, I mean, the market has been beating expectation.
Yes.
Right?
Yes.
Beating expectation, you're getting higher figures than what the markets are forecasting.
Yes.
I think that is the tone of this year, basically, right? That's the theme for this year, that, you know, the labor market is strengthening, it's performing well. I think it amazed even some of the Fed officials.
Yeah, look at that. There's your numbers. You're right.
Yeah.
Jan, we beat the expectations. It was only May,
Only
and August.
and the previous one.
That's it.
All right.
Which was July. Sorry, July. Yeah. So very, very, you're 100% spot on, bro. The entire year has been good.
Basically, right?
Has been-
Only on 2 releases.
Only 2 releases.
Yeah, I think, look, it's still going to continue like this for the rest of the year, right?
Okay.
Looking at where we are in the year right now, we are in the latter stages of the year, and also looking at how that inflation print is coming down nicely, anticipating cuts. So I think now businesses, when the cut starts coming, you just mentioned something, that businesses do want to borrow money, right?
Yes.
So which means when they continue borrowing money at a lesser cost, they're going to create more jobs, to create more jobs.
Exactly.
And then we might see this even go to higher figures.
To higher figures.
Right. So I'm
Exactly.
anticipating NFP to just perform well the rest of this year.
Yeah. So which means we'll be looking for a stronger dollar possibly Friday, short term. The forecast, obviously, we want to beat that 170, 180,000.
Yeah.
Exactly.
Yeah.
That's the standard, I believe, benchmark that we normally go for, right? About 170, 180,000 jobs. But let's see how it goes. I mean, we will be streaming it. Yeah.
Yeah, definitely. We'll be streaming it. The guys can catch us at 2 p.m.
Yeah.
on Friday, the 6th of September.
Yes. And
right?
then thereafter, guys, CPI, we catch both of them. All
the
right.
week after that. So now that unemployment figures there, I mean, unemployment rate figures is on 6, we jumped to 6.5%. Wait, that's the CAD. No, that's the CAD. The dollar.
Oh, there we go. There we go. Gotcha.
4.2. Well, it went to 4.3, sorry.
So let's see here. From Jan, 3.7. We've been running in the 3s. It's the highest now, 4.3%, right?
So this is the first time it went above 4%. After how long? Maybe scroll down. Let's see the last time it was there. I think it was during COVID times.
Yeah, it's been 3.
There
There
we
we
go.
go. 4 point there. That was 2022.
That's 2022.
So what it did was it went 4.8, right?
2021.
So that was good for the dollar, obviously. Then it came down 4%. It's been under that 4% now ever since. And then now recently again went up again above the 4 point. June. So June, hold on, bro. Look at this. 4%, June 2024. Did we not see a June now as well? Was there another June?
No, it's the January. That 4%, that 2022. Is it
Feb.
No, it's a Feb.
It's a Feb. Okay, I thought it was a June.
Yeah.
All right, interesting. Okay, all right. So Feb 4% and then June 4%.
So unemployment rate has been rising. Job creation is there.
Yeah.
And also check the JOLTS report there, because it's job openings there. Let's check the JOLTS report. It's expected to be released tomorrow. Right, that's tomorrow. It's just around 8 million. Let's say 8.1 million.
8.1 million. It was higher. That was 2023. You see that October. And then from October 2023, 9.6 million. And then it started coming down, spiked again in Jan, and it then retraced from that. Interesting.
So this NFP coming out here is just going to be also interesting, looking at where unemployment rate is.
Yes.
The mandate the Fed has on on job creation in the US, and also in anticipation of that CPI print.
Yeah.
It's going to be interesting.
And also, we might get more jobs there. Also, for the mere fact that inflation is coming down, right? Which means people can afford to pay salaries which then adds into that job creation that you had mentioned, whether it's we're paying wages weekly or they're doing monthly salaries. But the point is they'll be able to do it so they can create more jobs for more productivity for goods and service to be sold, which is going to be just like you said, extremely interesting to see if there's more jobs or not this Friday.
I think there could be certain businesses that are in so much debt that when the interest rates goes down, they'll be able to pay more, but not create jobs as yet to cover the debt maybe.
From a business perspective.
From a business perspective.
Okay.
Right, maybe. Yeah, that's the scenario I'm playing on my, like in my head. But
so it's twofold. From a debt perspective, but then also there are businesses that can hire people. Can hire people because they need to produce.
Of course.
If they're not producing, they can't be sustainable as a business. So those two things to see what this job market does on Friday is going to be very, very interesting.
There you go, guys. Yo, proper stuff. So look, I think let's wrap it up. September, very important month in the markets for us traders. We're anticipating lower figures for the CPI.
Yeah.
The interest rates, higher figures for NFP.
Yeah.
And whatever we do, we're just going to find opportunities.
Let's find when we can adapt. We adapt as always.
Definitely.
Whether it's a weak figure or a strong figure, we will adapt to that specific market and that data release when it comes out.
Yeah. So watch out for that interest rates. It's on the 11th, I think. Let's quickly check.
The CPI.
No, the interest rates. Or let's just tell them when the CPI is, actually.
Yeah, CPI is that's on 12th of September.
CPI 12th September.
No, sorry, 11th.
11th September, 11th. The CPI report is coming out.
Yeah, it's coming out. And then we have monetary. Here we go.
On the 18th.
18th of September.
18th September, FOMC statement.
FOMC. The federal funds rate, the FOMC economic projections. And that word projections there, bro.
Yeah, projections.
That word. FOMC statement and then obviously the press.
And it's important that guys watch the press conference. So the announcement is at 8. Right?
Yeah.
8 p.m. The press conference 30 minutes after that at 8:30. It's important that you also watch the press conference, guys, because there's going to be a lot of questions from the journalists that are going to be there.
Yes.
They're going to be asking, all right, so we're seeing that if they cut, of course, all right, so we're seeing the cuts. What are you forecasting? Those questions.
What do you think happens to the labor market?
Yeah.
What can investors anticipate if the cuts come?
The PCE or projection, look at PCE. It's very interesting, guys, listening at those questions. Very interesting. Yeah. So, we're excited. We're excited.
Extremely, bro. Extremely.
Yeah.
And again, I'm going to actually echo your words there. It is a great time to be a trader.
Of course. You see this time. Get in touch with us, tdmarketsacademy.com. Is it .com?
TD Markets, yes.
tdmarketsacademy.com. Get in touch with us, guys. tdmarketsacademy.com.
Yep.
Fill in the sign-up form.
Yeah.
We'll get in touch with you.
And then, guys, don't forget, it's been all over the social media.
Yep.
We're going to Emalahleni.
Yes, the first stop of our tour, of our
roadshow.
Yeah.
All right, Emalahleni, that's Mpumalanga.
Yeah,
I have the province right, yeah?
Yeah, Mpumalanga.
Mpumalanga, Emalahleni. It will be at the Ridge Casino. The times there is 10, I believe, 10 a.m.
From 10 to 12, but you can just go to 1. You know how these seminars are. Questions in between.
Yeah.
So just be free up until 1.
Yeah, we're looking forward to seeing you guys there. If you're in that specific region, let's have the questions. We will be there to chat a little bit as well and let you know what's happening with the academy. It will be an absolute pleasure chatting to you.
So what can the guys expect from the academy? Because TD Markets as a company is going there, also TD Markets Academy, right? So what can they expect from the academy?
Well, we have a master class that we are putting together.
A master class.
A master class that we're putting together.
Not a Forex beginners. No, a Forex master class, guys.
It's a master class, guys. It is a combination of a couple of things, which is inclusive of some practicality and demonstration. We'll just leave it there. Let's not give them too much.
No, sure, But I think the word master class, guys should be excited about that. Right? So, guys, look, catch us this coming Saturday. At 7th, on the 7th, right?
Of September.
So NFP the 6th, 7th of September. The tour, the road show starts. Emalahleni, the Ridge Casino. That's the venue.
At 10 a.m., guys.
10 a.m.
Visit our website, and visit our website if you'd like to sign up and register for it as well. All right, www.tdmarkets.com. You can also do it via our academy page as well, our website. I believe also on all social media platforms. They can click on there as well.
Yep.
Facebook, YouTube. You can go to, I believe, TikTok as well, and Instagram.
Yeah, Instagram. Yeah.
There we go.
All right. The last time we had a tour was last year. We went to Botswana, went to Namibia.
Yeah.
This year it was Zambia. Went to Zambia. It was this year, ne?
Yeah, it was this year.
Yeah, this year into Zambia.
Yeah.
Look, a lot of great things are happening in the company, guys. Just keep an eye out on the social media platforms.
Yep.
TD Markets Academy is going to the world.
Yeah, I'm telling you, man.
Hey, look.
We're busy.
Something is happening.
As they say, we're cooking.
We're cooking, definitely. We're cooking. As the youngings say, let them cook.
Let them cook.
Let them cook.
I
Let the
heard that,
youngings. Does your children say that?
My 12-year-old says he's cooking.
Yeah.
He's cooking.
So
Did he cooking?
Or when he talks to you, when he's trying to
Explain
explain something, and then you interject. Does she say, "Let me cook"? Wait, let me cook. Let me cook. That's what they say.
Let me cook my issue. My issue. My issue. Let me cook it.
My issue. Hey man, look.
All right.
Yeah, but no, guys, look, we're excited for the roadshow.
Yeah.
So we have 2 roadshows.
Yeah.
Well, this towards the end of the year, but this month we have 2 places we're going to. Same.
Yeah.
Okay, I don't want to reveal.
Yeah, let's not reveal. You guys almost got us there. That's what family does. Sometimes they pull things out of you.
Let's not reveal. But after this one,
Yeah.
we're going somewhere again.
We'll talk.
Right? We'll talk about that.
Family meeting.
Family meeting. We'll talk about that. Definitely.
All right.
Yeah, no, look, I think it's all good. Episode
15.
15.
Yeah.
It's good to be back. So do catch us, guys, every Tuesday at 6 p.m. on YouTube. Our podcast episode. We're going to have guests.
Yeah.
We're waiting for the part 2 with Jaguar. I know Jaguar will be watching this.
Jag
will be watching this, waiting for the part 2.
Fire. We need you here in the office, yeah?
Yeah, in the office, waiting for the part 2. And we're going to get more guests. Some of you guys know, some of you guys don't know. But trust me, it's going to be an epic episodes that we are lining up for you guys.
Absolutely.
Yep.
All right, brother.
Yeah, man.
I think that's it.
That's it. Thank you so much for joining us, guys. Do like, share, subscribe. I don't know. Do whatever you need to do. Let's get engagement rolling. Comment down below. Yeah.
Get involved, guys.
Cool stuff.
All right.
Yeah.
See you guys.
Cheers, guys.
Ciao.